Then we have the head and shoulders. Head and shoulders are a lot more distinct. Head and shoulders is a very important pattern when it develops. And it takes a time to develop. Okay. And head and shoulders is exactly what it sounds like. It is two shoulders of equal height with a head formed in between. This is the head. These are the shoulders. But what you would see first is price moving up to the head, the shoulder, coming back down to what we actually, in this case, it is a support line, but it's also called what we call the neckline. It's bouncing off of that support line and coming back up here higher than the shoulder, coming back down to that resistance line, that support line, bouncing off of it and forming the next shoulder. When it comes back down to that resistance line, it's telling us we're about to get a breakout down. And this is historically based on the psychology of the markets. You actually have the exact inverted head and shoulders, which occurs in the opposite way, because this starts from an uptrend and then moves, and this is the pattern that develops, and then it moves into a downtrend. This starts the opposite way with a downtrend, but forms, if you turn it upside down, it forms the same thing on a chart. And I don't know what's wrong with the system here, but it just doesn't seem to want to turn off my markers. The popular head and shoulders pattern is essentially a triple top, except that all of the peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. Some investors have specific beliefs about the amount of the bearish pullback that should occur between the tops and the bottoms. And inverse head and shoulders is similar to that, except it's in the reverse. Now, there is a set of rules that go with a head and shoulder, and it will help you find your targets. Okay. And this is based on your neckline, your head, the top of your head, where it actually peaked at each, and where your shoulders began. The calculation is your target price is the neckline, which is the resistance line, minus the head minus the neck. So if we were to say, let's give the neckline here a rating of 1. Let's say the headline is 2, but it would actually be the price. You would look for the actual price that this was formed at, the head term was formed. You would actually look at the actual price that the neck formed. And what you would do is you would take the neckline, in this case, we said it's number 1 or $1 or whatever you want to call it. And so it's 1 minus the head. In this case, we said the head was 2 minus the neckline, which we already assigned the number 1, and this will give us the target price moving down. So we have 1 minus 2 minus 1. So 2 minus 1 is 1. 1 minus 1 gives us 0. And exact difference down would be 0. So if this was 2, this was 1 on a graph, this would have been 0. And this becomes our target price, or equal to the distance here of where we're expecting that asset to fall to. So the target price is when it breaks out is where you would set your target trade. It could fall much below that, but this is where we would set our target based on the formula for using this to make a trading decision. So if this was gold, and gold, the neckline of gold was 1,200, happened to be at $1,200. It peaked at the head at $1,250. Okay. We would then set our target at what? Our target would be T equals 1,200 minus 1,250 minus 1200, which would give us 1150. So our target if this would gold would have been for gold to fall down to 1150 in its trend. And this is the target that we're looking for to set our take profit point as we enter. We would enter a price here, a trade here after we got the confirming candle, and we would take it to that target at 1150. So we could pick up, well, you wouldn't get in exactly 1200. So say you got in 1175, 1180, and you traded it down to 1150, you would pick up $30 profit per ounce of gold. Same calculations happen in a inverse trend, except the trade's going up. Same numbers, it's just reversed. So we also have a multiple tops chart pattern occurs in an ongoing uptrend and indicates that the trend is nearing exhaustion. If a security repeatedly has difficulty surpassing a certain price point, a multiple top pattern will exist. And the bullish trend progresses. Okay, so here we have what's a double top. So price is moving up in an uptrend, hits this resistance line, bounces off of it, comes off to the support line, comes off to the resistance line, goes back up to the support line, and then falls back down and breaks through. So they look just like W's. They're double tops, and we also go on to the next step, which is a triple top, and the calculations are done exactly the same. It's your target is S, which is your support line, which would be the bottom of, see the double top here? Up, down, up, down. So our target would be T equals S, the support level. So say for gold, this was 1200. And this is an actual number in reality because it's a number that appeared on the chart. The top would say was at 1260. And then you just do your calculations. And this is where you set your target price moving down. It's just the opposite if you're coming off of a downtrend. And the calculations are just in the opposite direction. Okay, then you go to the very, very important one. The more complicated these are, the less times that they appear, and the more valid they are when they do appear. And that's a triple top and a triple bottom. This is when it hits those support and resistance 3 times. Okay, it's a W, or say it's 2 V's, or a W plus a V. Does the same exact thing, but when that happens a 3rd time, and then you have a breakout, that breakout is very, very vital and very important. And you still have the same formula. Okay, it's in this case, when you have a triple, the target is the support line minus the resistance line. Okay. So an important measure of the quality of a pattern is the trend that precedes it. It does not matter whether the trend is bullish or bearish, but the consistency and the duration of the initial trend partly determines the well-formedness of the pattern. In other words, if it's a short-term uptrend and it's not very steep and this pattern exists, you might get the breakout, but it's not going to be about. If you have a very strong uptrend and it's been continuing for quite a while, the more likely these patterns will be very accurate in their decision. So in other words, here you can see the strong initial trend. It was moving up, then it down formed and formed the channel. Okay. Here you had a slightly weak uptrend and it just moved into this channel, but it also tells you that even though it breaks out, it might even not have the momentum to go that far, or it might not even have enough momentum to carry it forward. Okay. So the pattern is said to have broken out once it is either across the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, it is called a continuation pattern. So in other words, if the price breaks out, if you're in an uptrend and the price breaks out towards up, it is considered a continuation. If it breaks out and goes downward, or the opposite direction of the trend, it is then considered a reversal pattern. So in other words, market's moving up, the breakout is up, continuation. Market is moving up, breakout is down, reversal. Same thing in the opposite direction if it's a downtrend moving into these. Now, there are 6 simple formats. You have falling wedges, bullish triangles, bullish pennants, rising wedges, bullish triangles, and bearish pennants. When you have these correctly, and in binary options, you don't set your stop loss and take profit points. But when you trade the simplified CFD and Forex on our platform, you do. And this will give you your specific entry level. It'll tell you where to take your stop loss and where to set your profit levels when you are trading. And each one of these helps you make those determinations. So you have retracements, reversals, continuations, and breakouts. Now also we have, so we talked about continuations and reversals, okay? And they are how the pattern moves in a chart. A pattern is just simply a series of data that repeats in a recognizable way. We don't want to overcomplicate it. We're just looking for something we can recognize. It can be identified in the history of an asset being evaluated or other assets with similar characteristics. Patterns often include the study of volume as well as price, because volume, as I said to you earlier, should support the movement. If you see a trend moving up or down, if the volume is consistent with that trend, and then you have a shift in volume, either stronger volume or lower volume, when volume falls, that means the market traders are leaving the market. When volume increases, they're supporting that move. Okay. And it's important to be able to look at that together. Now, the other thing is, a very good way to trade these patterns is to combine them with Fibonacci retracements. Because Fibonacci retracements will help you learn what level these prices should bounce back to, whether it's a 37, whether a 31, a 23, a 61, a 50% retracement level, to help you predict levels. Okay. Because retracements are very, very important. So what exactly are retracements? They are price reversals that are produced temporarily within a larger movement. Their most important features, they do not last for long before price resumes its original direction. You need to know how to distinguish price retracements from the more serious and permanent reversals. So like you see here in this chart, we had price moving up, at a steady uptrend. We had the swing low, we had a reversal, we had a retracement, and all it means is it was retracing where it had been. Okay. It hit a level here and then reversed and went back into its previous uptrend. Okay. This can be very good trading here. This could be a very good entry point here. And you combine these with specific tools, especially Fibonacci levels, to determine where these will be, what levels you should expect to have the recovery and the reaction. But you have to be able to determine what is a retracement and what is a trend reversal, because they are quite different. Trend reversal means you're moving into a new downtrend. The buyers have now been exhausted. The sellers are taking control of the market, and they're pushing price down. A retracement is just the buyers are easing back a wee little bit. They haven't lost control of the markets. So retracements are temporary price reversals that take place within a larger trend. The key here is that the price reversals are temporary and do not indicate a change in the larger trend. The importance of recognizing retracements. It is important to know how to distinguish a retracement from reversal. There are several key differences between the two that you should take into account when classifying a price movement. Now, Fibonacci retracements help you determine if you actually have a retracement and where these are. Now, Fibonacci numbers were developed by a mathematician in the 12th century, but they can be put on a chart very easy, and the significant levels are 61.8, 50, and 38.2. And these are measurements of where price would retrace itself based on the length of the previous trend. So in other words, if price was in an uptrend and the uptrend started here and ended here, your retracement levels would be here, 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 and here. This is 61.8% of the previous move. This is 50% of the previous move. This is 38.2, and this is an important one, but it's the 23.6 level of the prior previous move. Okay. So if we're in a retracement, we would expect price to come down here and then retrace. If it doesn't come here, one of these levels is where we would expect it to retrace. Because like I said, the bears have not taken domination of the market. The bulls are just resting here. Okay, and that is the biggest difference because it is a short-term movement within a longer-term trend. Okay. So Fibonacci replacements were designed to forecast the scope of corrections when trends are prevalent. The most common retracement levels can be achieved at 61.8, 50, and 38.2. Now next month we have a class on Fibonacci retracements, and we'll teach you how to put them on charts. But this is why do they work, and why is it important to distinguish between retracements and reversals? This is because traders have to contend with difficult decisions whenever reversals occur. For instance, should they hold their position open but the risk of a serious loss because the price is moving against them? Alternatively, when it's just a retracement, you would want to hold on to your position because it's going to retrace and come back to where it was. Alternatively, they could sell at the first sign of a drop and then rebuy at a more favorable discount. However, then they risk the chance of losing larger gains if the price should suddenly surge back in its original direction. So common technical indicators that are used to monitor retracements are Fibonacci retracements, trend lines, and support and resistance lines. There are several key differences in distinguishing a temporary price change and a temporary price retracement from a long-term trend reversal. Reversals are defined as a change in the overall trend of the price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal occurs. So these are the difference. These are who's controlling the market and where price should go. And you have to learn how to see these. And you need to see these with taking other indicators in mind at the same time. Okay. So whenever a price reverses, most traders and investors are faced with a tough decision. Do they hold? Do they sell? Do they sell and rebuy? So they have to properly identify these. So you can have, in an overall trend, several retracements. Okay, but when price hits a swing high and then turns around and moves down, it's not a retracement. Then it becomes a downtrend. So you have to be able to identify what the difference is. So triangles help you identify, because remember, you have a triangle breakout that's a continuation and a triangle breakout that's a reversal. Okay, and these patterns will help you determine what to expect. Okay, and on that note, we're going to end this class, and we're going to pick up next month We have a class on support and resistance, so we can learn how to judge these breakouts and the levels. We also have a class on Fibonacci next month. And next month we have a whole new class on trading simplified Forex on the binary options platform. And we have a 1-hour class next month in trading ladder. And using ladder trading with patterns and breakouts can be very beneficial to making a lot of profit using ladders to determine where price should go to. So have a very good night now. Thank you very much for joining us, and thank you for being part of the 23 Traders family. Have a good evening now.